Hello, everyone. Thank you for joining us for today's event featuring Daniel Peris speaking on his book, Getting Back to Business: Why Modern Portfolio Theory Fails Investors and How You Can Bring Common Sense to Your Portfolio. My name is Srish Chatterjee, Professor of Finance and Business Economics at the Gabelli School and Gabelli Chair in Global Security Analysis, and it's my pleasure to be here on behalf of the Gabelli School. The Gabelli School Centennial Virtual Speaker Series began in 2020, marking 100 years of purpose driven business education at Fordham. In the last year, the Gabelli Center for Global Security Analysis and our wonderful partners, the Museum of American Finance and CFA Society of New York, have sponsored more than 50 events that have drawn 10,000 plus attendees. We are tremendously proud of this dynamic partnership, and a full archive of our video content will be shared in the thank you email that you will receive. In just a moment, James Kelly, Director of the Gabelli Center for Global Security Analysis, will give a full introduction of our speaker. Mr. Peris will deliver a presentation for about 40 minutes, maybe roughly 30 minutes, I should say, at which point he will address questions submitted through the question field that is located below the video player. Please feel free to submit questions at any point during our event. We'll be addressing as many of them as possible during the session. I also want to share that all attendees of today's event will be receiving digital copies of Mr. Peris's book with information coming to you following our event. Before I turn it over to Professor Kelly, I want to warmly ask that you consider making a donation to the Gabelli School Centennial Fund. You can make a tax-exempt gift quickly and securely online at the links provided in the chat. And now, without further ado, I turn it over to Professor Jim Kelly.
Thank you, Shreesh. It's my pleasure to introduce Daniel Peris, Senior Vice President and Senior Portfolio Manager of Federated Hermes in Pittsburgh, where he oversees $25 billion in dividend-focused portfolios. Daniel is unique in that he brings a historian's perspective to his investment process. Before transitioning into asset management, Daniel was an academic historian focusing on the history of the Soviet Union. After graduating from Williams College, he earned his master's degree at Oxford University and his PhD at the University of Illinois, where he received a Fulbright Hays grant to conduct archival research in the former Soviet Union. He also held a postdoctoral fellowship at the Hoover Institution of Stanford University. He is the author of 3 books, including his most recent book, Getting Back to Business: Why Modern Portfolio Theory Fails Investors and How You Can Bring Common Sense to Your Portfolio. Perhaps a good way to start would be to ask Daniel, how did you as a historian transition to asset management? Daniel?
Thank you, Jim, and thank you, Sreesh, and thank you, everyone involved in having me give this presentation. I very much appreciate it. It is an interesting tale of how I ended up, from one position and ended up doing something quite dramatically different. But in my mind, managing assets in the way that I do is really a continuation of the historical theme. That is, I approach almost all issues of import from a historical theme. I was a child of the late Cold War, the Reagan era Cold War, very, very interested in politics, international relations, and so forth, and decided when I entered college in 1982 that I was going to focus on that, learned Russian, graduate school in Russian studies, PhD in Russian studies, a lot of time in the Soviet Union in the 1990s, Russia. Ended up marrying a Russian, my wife to this day. And that was a fascinating period in my life. But as I matured and I looked at the job market, elements of the market and business thrust themselves into the equation in a way that perhaps when I was 18, I didn't realize. That is, the supply and demand issues for teachers of Russian history and the overproduction, oversupply of PhDs in Russian history. It's pretty evident. When I came out, I did get a job, a good teaching job, a 2-2 job, something that Professors Kelly and Chatterjee might appreciate with research support. But I could see the writing on the wall. In the mid-90s, I had entered graduate school and the Soviet Union was a threat and there was a lot of funding. I came out of graduate school in the mid-90s. Russia was a mess. The funding and enrollments had disappeared. And so I made a decision to move into something else, into business, and to leave academia. And I did so in 1997 after a prior book on Soviet history had been published or accepted for publication. So I left, made my way to New York, and called a number of consulting companies and said, hey, how would you like to have a 32-year-old, 33-year-old who's never opened an Excel spreadsheet with a PhD in Soviet history come and help you on your business? And of course, they hung up on me quite a bit. I got nowhere. But I eventually convinced a consulting company that wanted someone who could write well, and they would take care of the business end. And they hired me. And I had a number of transition jobs in consulting and finance, on-the-job MBA, I would call it. I didn't have the stomach at that point to go back to an MBA, having just left the academy, having been in the academy for so long. So kind of in the trenches, MBA, on-the-job MBA for a number of firms. Ended up doing research and writing for Argus Research in New York, which is a small independent stock research firm. Very grateful to John Eade, the longtime director there. And there I settled in, started taking the CFA exam, including courses from the CFA of Society, which is graciously co-sponsoring this event, CFA Society of New York. And after 9/11, my wife and I were a little too close there for our comfort. We decided to leave New York, and I got a job in Pittsburgh for now Federated Hermes, again as a stock analyst, and I moved my way up over the past 20 years and now focus on the dividends. But the question of how does the historical role, what is the role of a historian in finance? To me, it's never really left. It's not two careers, it's one career. As a historian of the Soviet Union, now I'm a historian practitioner of the capital markets. And as I made the transition, I had to read and write and focus on everyone else's rules. The CFA took that in 3 years. That was very unpleasant. I'm sure pretty much everyone who's listening to this has gone through that degree of unpleasantness. In order to show credibility, I quickly memorized the rules. And then I started working, whether for Argus or for Federated, and there are rules about how you value securities, how you manage portfolios. And in order to stay in my new career, I did those rules. But within a couple years of settling in at Federated, the historian in me comes back out. Frankly, it comes out all the time as my kind of favorite introduction to any statement is, as a historian, I'll almost answer any question with that preface. But I started applying that to my day job of looking into the capital markets and the structure. And at the time, I was an analyst, a sector analyst, supporting a variety of portfolios, variety of investment styles. But as a historian, and looking back at the stock market, after I'd memorized everything I was told to memorize in order to pass the CFA, it was very, very clear to me, even then, 20 years ago, that the 1990s and then the early aughts that I was living in were anomalous from a historical perspective in terms of the structure of the stock market and in terms of the tools that we use in the stock market. And that a cash flow-based relationship to investments is the norm, not the exception. It had become the exception in the 90s. I thought, that's strange. I mean, it's very profitable, I suppose. You buy low, sell high, repeat frequently. That is apparently the mandate for everyone who's listening in here, mostly, and that's fine. But the drivers of the value of businesses in most places and most times is the distributable cash flows that minority share owners, meaning not majority controlling share owners, have access to dividends in the case of equities. And so I started as I moved up within Federated, ended up being appointed a portfolio manager in 2006 for a dividend fund. Not that surprising. And from that perch, I began research and writing and going back. And I had an intuitive sense that as a historian, the dividends were a historically validated approach to business ownership. But I wanted to document that more. I had documented my little corner of Soviet history. And now I was going to document this. And I wrote a couple books, one in 2011 about dividend investing, a follow-up volume, very similar in 2013, companion volume, about the mechanics of dividend investing, and to me, why it was logical from a business ownership perspective and from a historical perspective. And things advanced. But as I continued down that path, both of managing assets and of exploring the history, I kept on running up against modern portfolio theory. And I mean that in a problematic way. Because modern portfolio theory as practice, again, most people will argue that it's just a theoretical construct. It's not really practice, but there are elements of it which are practiced every day in everybody's account all the time. And as I was stumbling against them, I thought, this doesn't make a lot of sense to me. As a historian, I'm going to go back and understand where this came from. And that's where Getting Back to Business came from. It came out in 2018. I'm delighted to have this opportunity to present it. If it would have been, this is almost like a normal book tour, except we had COVID and everyone lost more than 2 years. So I do appreciate and I'm grateful to the Gabelli School and Professors Kelly and Chatterjee for giving me an opportunity to present this. The book Getting Back to Business makes the straightforward argument, as you would about almost any activity, that knowing the history of said activity is useful. Why did a particular paradigm, why did a particular rules that we all learn in school, why did they come into being, and are they still relevant? That last part's the really important question when it comes to modern portfolio theory. I can argue at any level that, if you're a brain surgeon, you ought to know the history of brain surgery. What worked in the past, what didn't work in the past, what were the developments, what were the catalysts for the developments, what were the circumstances that led to particular procedures. If you're a plumber, same rules apply. If you are in almost any profession, knowing the history of that profession, I think adds value to you as a practitioner. And the historical profession, I would argue, the finance profession, I would argue, it lacks a historical sensibility. A lot of people come in, want to make a lot of money. They ask a very simple question: what are the rules to make a lot of money? Tell me the rules. I'm going to memorize them. I'm going to apply them. I'm going to make a lot of money. And we have droves and droves and droves of people, I will say, in business schools, hopefully not in the Gabelli School, but through the CFA program and everyone else, all the internships in the investment banks, all quickly seeking, what are the rules? I'm real smart. I'll memorize the rules. I'll apply them, and everything's going to be wonderful. And that's certainly not my approach, because as I argue in the book and want to kind of summarize here for you today, that the rules that we're using all have a history. And it behooves all of us to know that history, to ask a simple question: do the rules still make sense today? Some of them might. Some of them might. Some of them might not. And my conclusion about MPT was, well, boy, it's a creature of its time, the 1950s. That's 70 years ago. A show of hands, I can't see you all, but a show of hands of you who are super comfortable using 70-year-old technology. Probably not many. So that's the logic behind this. So let me go back and provide a little bit of the history. Up until the crash, there really was no theory of investment. So we have the crash and the depression in 1929 and continuing to the 1930s. The introductory portion of the book chronicles what stock market investing was like up through the 1920s. And it's kind of Wild West. It's very interesting. There's been some fascinating research about the trends in the market in the 19th century and the returns of stocks versus bonds, and good behavior and a lot of bad behavior throughout the 19th century and through the 1920s and the 30s. But there really was no systematic treatment of investments the way that we have. Younger investors today take for granted the CFA Society. They take for granted MBA programs. None of these things existed up until the 1930s. There really was no set of rules. There were opinions. There were some methods. There were individuals saying, kind of voices in the wilderness saying, hey, this is how it should be in terms of either valuing the stock or treating a portfolio, but none of them had become canonical. Irving Fisher in 1906 put out some, what I consider now canonical, but I don't know that he was influencing a great deal of people. He was a prominent economist, and he talked about the value of cash flows for valuing securities, but it didn't necessarily catch on per se. He became more famous in 1929 for talking about the permanent plateau in share prices in September of 1929. A lifetime of great academic work went up in a puff of smoke for him. 1930s happens, it's a mess. And now some very sober people start asking structural questions, saying what happened and what can we do going forward to avoid this? And I refer to this in the book as kind of the forefathers of modern finance. And there are a number of them scraping around in the 1930s. This is a period in which the structure that we know, the SEC comes into being, the rules, the Advisors Act, 1940, the two SEC Acts, 1933 and 1934, and the beginning of structure begins to appear. But among them writing at the time is Ben Graham, well known as the father in value investing. But his book, you ought to go back and read the first edition of Security Analysis. It's not really about value investing, it's about investing. And it lays out all of the groundwork for investing. And of course, it's all about cash flows and dividends. Company doesn't have distributable cash flows, they're nothing. Your minority shareholder, you get nothing other than the dividend. I don't think value investors would recognize, or Ben Graham would recognize modern value investors that are very happy and content to focus on securities without dividends. Again, there's nothing wrong with that, but it's very different from the original Ben Graham. Second, John Maynard Keynes, dealing with macroeconomic issues in the market, particularly the psychology of the market, fascinating work in The General Theory in 1936. And then John Burr Williams, kind of an outcast academic, doing the math of discounted cash flows in 1938. He had to self-publish the book. He had to pay Harvard to put the charts in his books because they didn't want to put all the charts in his books for showing the calculations necessary for discounted cash flows. They did not create a theory of the market, but they did clear up the debris of the 1930s and said, folks, you need to be a little more systematic about this. Chaos is not a good investment theory. For speculation, chaos is great. But for investment, chaos is not good. And what we've had up to this point was chaos. So we are going to very soberly outline more serious approaches to this exercise. Now, these three gentlemen don't necessarily agree with each other. They're writing on different topics. But in retrospect, you can see that they were beginning to clear the debris and create a framework for analysis. The war intervenes. Not much happens, and you come to the post-war, in terms of financial theory, you come to the 1950s. It's peacetime, and academics can begin to turn to this topic again, and they do. And here's where it gets very, very interesting. We have a 21-year-old, 22-year-old graduate student casting around for a topic. Harry Markowitz, I believe he's still alive. I don't know how well, but in La Jolla, California, I know as of maybe a year or two ago, he was giving interviews. I wish him well. And he comes up with an article. It's very short. It's 15, 20 pages about portfolio theory. And it's published in 1952. And it's a very nice piece. It absolutely is a very nice piece. It creates a spectrum of risk and reward, defining in a shorthand fashion risk and defining in a shorthand fashion reward. It highlights the benefits of diversification. He elaborates on the book in 1959 in a much longer, kind of harder to read version that goes into much greater detail. But there you have the 2 points of modern portfolio theory, 1952 and 1959. And the statement or the summary, which we all know and understand, is that for certain degree of risk and certain degree of reward, And if you accept standard deviation of total return as the measure of risk, then there's an efficient frontier between risk and reward, how much risk you're willing to take, how much reward, and that diversification, the last free lunch, and so forth. And off he went. He was an operations guy. He is an operations guy, a systems guy. He likes to write algorithms for optimizing things. If you read his work, it's modern portfolio theory is a very important part of it, but it's really an outgrowth of his interest in systems theory, which is great, in optimization. And there's absolutely nothing wrong with that when you are looking at it in the context of what went before Harry Markowitz, which was nothing. So you have a system, a theory of portfolio management that was first. Maybe it's best, I don't think so, but it certainly was first. And I make the argument in the book in a number of different ways that MPT catches on not because it's a particularly good approach, but because it was the first coherent approach and it made sense in its time. That time being the 1950s, when prior to that, there is no proper theory, as it were, about systemic thinking of the market, when diversification in Harry Markowitz terms meant 10 stocks rather than 2 or 3. Remember, at the time, the leading brokers of the day were talking about putting all your eggs in one basket and watching that basket. Nothing wrong with that. Markowitz saying, well, maybe a few more eggs. And he showed the math, the very definitive, clear math of having 10. That's his definition of diversification in 1952 and 1959. It's not 5,000 securities in a $500,000 retail account owning 10 index funds. That's not diversification. That's just owning the market through 10 different structures. Again, as a historian, we are told, or as a historian, it's worth knowing that current investors are told day in and day out, diversify, diversify, diversify. Yeah, if the alternative was owning 2 or 3 securities, yeah, you should probably diversify. 10 or 20 is a better idea. Diversification currently where small retail accounts through index funds own thousands upon thousands of securities is not diversification. It's not risk reduction. It's not return maximization. It's just owning the market in a slightly more complicated way. May not be a bad idea, but know the history of that notion, not what it currently has become. Second issue in the 1950s. So first issue being diversification. Bravo to Harry Markowitz for emphasizing diversification against stockbrokers of the day who are encouraging people to own 2 or 3 stocks. Now, you as investors now should know that and what it means, and perhaps cautiously approach the over diversification that too many retail investors now encounter. Point 2. Markowitz made the assertion, and many other academics have made the assertion in the 1950s, that a capital gain and a dividend, in terms of total return, is identical. Money's money. It's fungible. You don't really care. His phrase, it's in the book, and it's in a number of other articles I've written or working on about that investors will be indifferent, I believe is the phrase, to a capital gain or a dividend payment. From there, the road to hell is paved with great intentions. From that simple statement, which is generally accepted by academic finance, the University of Chicago has no problem with that statement. The Journal of Finance has no problem with that statement. And certainly hedge funds have no problem with that statement. I, as a historian, have an enormous problem with that statement. A dividend is the result of business ownership. A capital gain is the result of a transaction in the marketplace. They bear almost no resemblance to one another. Yet in academic finance, they're identical. So when Harry Markowitz is coming up with a theory of portfolio management, it does not treat those entities differently. That's the fundamental flaw from my perspective of MPT, because that opened the floodgates along with all of the other developments in the 1950s and 60s, the quantification of human behavior, all the factors, the development of beta, and all these other factors of investment, an increasing shift from the cash one received as the owner of a business to share price changes that one can see in the marketplace, regardless of business ownership. You don't need to know what a company makes in order to benefit from share price change up or down, or whether it benefit if it goes up, suffer if it declines. And so we shifted, and I'm making this argument in a current publication. We shifted from a business ownership approach to investing in the stock market to a stock-based stock for buy low, sell high, repeat frequently. You don't care about the dividend. You don't even care what the company does. Clearly the case with a lot of SPACs currently. Not only do people not care, the companies don't actually do anything until they buy something. That was a fundamental flaw, I think, in modern portfolio theory. I posit modern portfolio theory as a theory of numbers for people who like numbers. There's nothing wrong with that. It is certainly not a theory of business ownership for people who might want to own businesses through the stock market. An example I give when I'm in with audiences whom I can see, show of hands, please, feel free. I can't see your hands, but feel free. Show of hands of those of you. Actually, I'll ask the people I can see. I don't know if they can even hear me. Jim Kelly, you don't have to answer this. I'll answer on your behalf. Does the Gabelli School pay you in shares of Tesla, or do they pay you in dollars twice a month? Listening. I'm going to bet it's in cash twice a month, not shares of Tesla. Professor Chatterjee, are you paid in cash twice a month, or are you paid in shares of Peloton, sir? I'm waiting. It is, you're paid in cash. Annalise, Keanu, Mark, the other people I can see, everyone's paid in cash. Businesses work in cash. Let me give you an example that I think most people can understand. Private businesses measure their success and their valuation based on their cash flows. Occasionally, there will be a bid price for a private business, but it's not a daily bid price. And the owners of the business are more oriented towards looking at the health of the business based on the cash flows of the business, the distributable cash flows. The best example that everyone can understand is real estate, rental real estate. Rental real estate does have a market with a price, but it's not every day. It's not particularly liquid. Most owners of real estate, residential rental real estate or commercial real estate, are looking at their cash flows and are judging the business based on the cash flows. Yes, it's nice that there's an exit, that there's a price, that there's a market price for real estate. But most of the time, you're looking at the underlying business, not the market price. I'm simply bringing that sentiment to how we would approach the Coca-Cola Company. It's very helpful that the Coca-Cola Company has a daily price, provides for liquidity, getting in, getting out. That's super. But at the end of the day, what matters is how the Coca-Cola Company is faring in terms of its internal operations. And for a minority shareholder, the best way to feel and live that is through the dividend that they're receiving. Businesses that are successful and growing have a high and growing dividend. Businesses that are not, that can't afford a dividend, startup businesses in distress, there's nothing wrong with any of those things. They shouldn't pay dividends, and one day hope they will. But for all ongoing enterprises, it's really that underlying cash flow in the private sector, that underlying cash flow that determines value and what most people are looking at. In the stock market, with a daily price and with the shift, the academic shift of defining modern portfolio theory from Harry Markowitz on, looking at total return, often very near-term total return. Of course, Harry Markowitz and the founding fathers will of course say that you want long-term total return. But as a practical matter, everyone's living at almost daily total return, weekly, monthly, quarterly. Think about what the component is of quarterly total return. It's almost entirely the share price movement. You get a share price change every day. You get a dividend once a quarter. So modern portfolio theory in application, and again, Harry Markowitz said that in pure form, MPT is can't be applied. He himself acknowledged that. But in the way that it's applied through all of the gatekeepers, through Morningstar, through all of the distribution firms, through the companies that we all work for in the industry, it's very share price focused. Again, there's nothing illegal, immoral, or unethical about buying low and selling high. But I do make the argument in the book that by focusing on a share price-based definition of risk, that is standard deviation of return, if I own a bunch of real estate, the standard deviation of the price change in the market price for my properties is of no concern to me whatsoever. Any risk to the income stream that's real risk. But as a practical matter, the definition of risk in MPT from Harry Markowitz's day focuses on share prices. As a practical matter, the whole MPT in terms of mean variance optimization. What are they trying to, mean variance optimization, show of hands of people who have had to deal with that technical term, mean variance optimization. It's mean variance optimization of basically of share prices. It's of total return, but when total return in our environment, short-term total returns driven by share prices, it becomes mean variance optimization of share prices. So along with many other factors, huge amounts of data developments, computer developments, democratization of investing, these are all good things. MPT created, as I said, a theory of gaming numbers, not a theory of business ownership through the stock market. And that's my fundamental criticism of it. And I think it enables bad behavior, excessive diversification, among other things, but bad behavior in terms of looking just at the share prices of businesses, not what you as a minority share owner actually get. I do end the book with an alternative theory. It's kind of structured around current asset allocation, but it takes it and flips it on its head. Instead of asset allocation by type, stocks, bonds, cash, private equities, private assets, whatever, I suggest, well, listen, the world is the way it is. I have to acknowledge these various asset categories and the behavior patterns that people have become accustomed to. But think about your assets in terms of their actual cash generation. You have assets that generate flat income streams. You have assets that generate high income streams. You have assets that generate variable income streams. And after 30 years of a highly speculative intellectual environment, we also have lots of assets that generate no income streams at all. And so the approach that I advocate for investors is to create asset allocation based on the types of income streams they're getting. So in effect, high yield bonds and parts of high dividend equities would be in the same category. Dividend growth might be in a different category from fixed income. But you're looking at assets based on what you as a minority shareholder actually receive. And then acknowledging the world the way it is, I do suggest in the asset allocation that there be a component of it that has no cash flows associated with it, because to do otherwise would preclude all of the stocks that have emerged over the last 30 years that don't pay dividends and have no intention of ever paying dividends. My current project, due out later this year, called The Ownership Dividend, addresses that issue about those companies. But in getting back to business in terms of portfolio theory, certainly suggest having an allocation to non-dividend paying stocks and do with it as you will. And whether it's a zero coupon bond or a non-dividend paying stock or a troubled value company that can't afford to pay a dividend, or a startup or your favorite biotech, whatever the case may be, they have a role to play in your portfolio. It's just not part of the income generation, which is the main function of the portfolio. So whether the non-dividend paying portions, 10%, 20%, 30%, 40%, it's a separate category and you're going to deal with it. There's no cash flow analysis to be done for that. Whatever intellectual tools you want to deploy, it's fine by me. But for the rest of the portfolio, depending on how you're risking, again, this ends up defining risk not as mean variance optimization of share prices, but of mean variance optimization of cash flows received by the investor, that the majority of a portfolio would have cash producing assets. This is also an interesting way of putting private and public assets, publicly traded assets, in the same portfolio. You can have your rental real estate. How many of you can go to your advisor, financial advisor, and say, hey, listen, I've got this real estate, I've got these stocks and bonds, and well, the financial advisor can't do anything with the real estate. They can't get paid on it. They can't advise you on it. Their portfolio theory doesn't include private assets. Now, actually, some financial advisors are getting software that is and the ability to include private assets, but as a general notion, including private real estate along with your stock market assets is not how current asset allocation works. But from a cash flow perspective, owning rental real estate, which generates a high and rising income stream is not unlike owning a dividend portfolio that aspires to generate a high and rising income stream. One has a daily price, the other doesn't. But if you look at the income streams, they're very similar. And from an asset perspective, asset allocation perspective, and portfolio perspective, they belong together. Whereas the stock that trades every day and has no income stream, that's something very, very different. So that's my suggestion. At that point, I think, Jim and Srice, I will hand it back to you for some Q&A.
Okay. Well, thank you very much, Daniel. Very informative, to say the least. I encourage everyone to please ask a question. We have a number of questions already in, but we really would like to encourage you to ask a few more. I have a number of questions from Mark Zashin, and he asked on one, what is your view of the dividends on preferred stocks versus dividends on common stocks?
Yeah, it's actually, I was working on for the historical project. Dividends, preferred stocks used to be much more prevalent than they are now. They're sort of a small corner of the market, and they don't really fit in modern portfolio theory and modern asset allocation. Obviously, it would have been because they were more significant a century ago, it would have been higher visibility. But interestingly, preferreds fit very nicely into what I'm advocating, a cash flow based approach. They're fixed income, but they have elements, equity-like elements of it. And so that you can slot them in to a range of income sources, not pure fixed income, not pure stock, not exactly private real estate, and they would fit in very nicely for that. Modern asset allocation doesn't really have a room for them because they're a bit of an oddball, but a cash flow based allocation system could easily accommodate them along with other types of income sources. I don't have a specific view on terms of the mechanics of preferreds, but the fact that they still have distributions and would fit nicely into a portfolio theory and portfolio construction process based on distributions.
Srish?
Daniel, as Jim mentioned, there are a number of excellent questions, and I hope we get to most of them. But you also told me and Jim that we could ask you some clarification questions about your talk before we get to the main question. So I do have one clarification question before I pick up the questions from the audience. And that is, you made a very interesting comment at the beginning of your talk when you said that once you started to work on investment, history came back to you sort of full force. You said that, I could see how important history is. And at that point, I wanted to ask you, is it because you feel that history repeats itself, or is it because you feel that history does not repeat itself?
Yeah, that's a great question. And if there's a flaw in me answering every question, whether what would you like to have for lunch today, or how do we fix the piping, or what should we invest in, if the fact that I answer every question with, as a historian, does come at a cost. It is an excellent risk management tool for dealing with issues that recur, like human bad behavior, which recurs all the time, human expectations, and so forth. So I view it substantially in terms of, because history repeats itself, and therefore being a historian prepares you for that. It may come in new envelopes, new forms, but there's a cost for that, and I have to admit that. I end up missing innovation. I absolutely end up missing innovation. Now, a lot of innovation fails. We saw the dot-com bubble and so forth, and there were so many instances of that. But I will be the first to admit that I am probably not wired to take the risk associated with substantial innovation with other people's money, maybe with my own. And I acknowledge it. That's why I'm not dismissive of startups, biotechs, the other companies, distressed companies in turnarounds. They shouldn't pay dividends. They should be part of an asset allocation, but it's a different analytical construct. And it is clear that although the dot-com stocks sort of all failed, but the technology revolution coming out of Silicon Valley for the last 3 decades has been spectacular. It's affected all of our lives. And I'm a beneficiary as much as anyone else of that. And there is an argument to be made for participating in that. So it's a balance. I am more the weight of history, but at least I know that, yes, that comes at a cost of missing innovation. That's why other people will invest in the innovative parts, the riskier parts, as I would argue, and why that should be part of somebody's portfolio. I probably would not have technology be 25% of the S&P 500. That goes without saying. And I wouldn't have large, successful technology companies not make cash distributions. To me, that's idiotic. But it is what it is. But I do have to be. I have to balance the offset of innovation with the learnings of history, the risk management tools that history provides.
We have several questions relating to stock buybacks. How do you view stock buybacks? Is that a legitimate return of capital to investors?
Yeah, it's obviously we do not view it as a helpful thing. It's in lieu of dividends. It doesn't help existing shareholders. It helps share sellers. So only in theory, if a company lowers its share count, do the existing shareholders benefit. But there's so many impediments to making a share buyback successful. It has to actually lower share count by the amount claimed. And so many share buybacks are exercised at high prices, not low prices. We've seen that over and over again in history. So in theory, back to Miller and Modigliani, I spend a lot of time in the new upcoming book, as well as this old one on Getting Back to Business. Share buybacks didn't exist as a problem or an issue in 1961 when Miller and Modigliani argue about dividend irrelevancy. Their argument is really misstated, but by people in the marketplace today. But share buybacks weren't significant then. They're very significant now. They've come from out of dividends, essentially. Share buybacks are now more significant in the aggregate than dividends. I argue that they do not benefit shareholders. They benefit share sellers. Again, they focus on a share price game, not a business ownership game. If you are a speculator, if you're a hedge fund, if you're Wall Street, you love share buybacks. Guess who benefits from a dividend other than the recipient? Nobody. Guess who benefits from a share buyback? Everybody but the long-term shareholder from whom that cash has come. So I have to make peace with share buybacks because they are so large. They're such a part of corporate America. Almost all of our companies that we own in our portfolios, reserve the option of share buybacks. They tend to be dividend centric, of course. But I can't draw a bright line and say we won't own any company that buybacks their shares because I wouldn't be able to own anything. But it's part of the Wall Street machine. Not a big fan, but I have to make peace with it. There are only a few instances when share buybacks make sense, and that has been very high yielding companies. If they're fortunate enough to have the cash, then essentially a share buyback protects the dividend for the remaining shareholders by getting rid of or diminishing dividend leakage. That happens on occasion, but when a company defines its primary goal of returning cash to shareholders through a share buyback, I say that's just not true and it's a bad idea. Mine is a minority view, not widely held in the marketplace, and I'm okay with that.
There was an early question on Charlie Munger about what you take from Charlie Munger. Let me expand that question a little bit, because in your book on strategic dividend, you have a very nice section on value investing. Now, since that book was written, have you additional comments to make to connect the dividend-centric view that you express so well with value investing?
That's a great question, and let me answer it as a historian. Because dividend investing and value investing were the same thing. Go back and read Security Analysis 1934, 1941, 1951, the various editions. He becomes a little more growth-oriented, Ben Graham, that is more tolerant of growth over time. But the original editions, there's almost no distinction between dividend investing and value investing. A little bit, but very, very little. The measure of a company's value was the dividend. Fast forward 100 years, almost 100 years, and we have, I would say that dividend investing is a subset of value investing. But there are lots of value companies, and we can see this in the marketplace right now. Companies trading at very low prices, depending on whatever valuation metric you want, other than the dividend, because they may not have a dividend, that trading at 5 or 10 times earnings, and they're stable businesses. But they don't have dividends, so they're not part of my universe. I am sympathetic to that. I am sympathetic to value investing. It's not my day job, but I'm sympathetic. I would caution investors to understand that because dividends have become such a beaten down part of the market, that's the new project that I'm working on, that represent a tiny slice of the market, that dividend investing does not offer value completeness. Value investing generally is going to include some dividend paying stocks, but it doesn't work the other way. So the two have gone in parallel but now separate paths over the past century. And I'm focused on one path, but I can appreciate proper value investing and firms that offer those products, investors that pursue that line. I choose to make the metric of value be the cash flow, but there are super companies out there in the marketplace that either can't or don't have a dividend that can be considered good value investments.
Daniel, here's a question from your former colleague at Federated, Bob Cowett. And he says, what data sets do you find most useful for longer term studies?
Yeah, so that's a great question, and I encourage you to look at the footnotes of your data sets. So Bob Schiller at Yale makes a data set available. Everyone uses it. I've used it in earlier books. It's great work for what it was, but you got to look at the footnotes. The tenure, the history of the bond market is a little bit misleading in a lot of data sets, because the 10-year, which is so dominant right now in the marketplace, actually is a relatively recent measure of risk-free rate, only created in the 1970s. And prior to that, people were using the 30-year or other constructed bond indices, and there's a lot of work being done. Edward Macquarie, a retired professor at Santa Clara University, has done yeoman work on trying to clean up all the indices, work that was done decades ago by Jeremy Siegel, by Will Getzman at Yale, by John Silla, by Schiller himself. And that work, again, those of you coming up through the system now, getting MBAs now, just assume all these data sets. You look at the data set, and it's great. Those data sets have histories. Even the data sets have histories. And boy, do you know the footnotes and the assumptions made, because the data prior to 1926 gets really squirrely really quickly. And even the data up until the last decades, there are a lot of assumptions made about data sources, the history of the S&P 500 and so forth. So as a historian, if you're going to make an investment decision based on some long-term trend, a la Jeremy Siegel, you better make sure you've checked the footnotes for those data trends, because as a Macquarie, I think, proved quite clear in regard to Jeremy Siegel's arguments about stocks for the long run, some of the data was earlier data upon which we're making assumptions is problematic. I had a guest on another podcast that I do who put together an 800-year series of bond rates. That's going back and showing a really long-term trend in bond rates. I've had Edward Macquarie on the show as well. And again, as a historian, it matters the history of the data set, not just the data set.
Here's a question that I think you may have already touched upon, but let me ask this question anyway. This is from James Visconti saying, how would your approach look at a company like Amazon, which plowed its profits back into the company to grow their stock price over time and has been a great investment?
Yeah, that's a fair question. I think I addressed it a little bit, Streets, when we were talking about on the innovation front. So the standard argument about not paying a dividend is that management knows more than you do, is smarter than you, and is in a better position to reinvest than hand it back to you. And people from the new economy have embraced that very fulsomely, and actually, Warren Buffett's embraced that same view from the old economy, that why would he return the money if he can buy an insurance company or a railroad? He's strictly old economy, not strictly anymore, but basically old economy. But he thinks he can do better than you can. And most of his investors have come to agree with him because he's proven he's right. And you could also argue that Jeff Bezos was right. He reinvested pretty well. I'm sure there are a couple mistakes along the way, but he invested very, very well. They're probably the exceptions that prove the rule. And that excessive, what I would say, reinvestment, and this quickly becomes a political issue, which I prefer not to go down, but that a lot of money is wasted in acquisitions. Mostly, it may not be actual investment in the business as opposed to huge M&A, which not paying a dividend. That is, paying a dividend restricts company management's ability to engage in large M&A activity. We like that. We're all in favor of that. But for companies that over the last 30 years, the NASDAQ companies, the technology companies, they've shown significant benefits of reinvestment. There's a philosophical issue there. I absolutely agree 100% with the question in regard to Amazon, and to some extent, even with Berkshire Hathaway. I, however, am a minority shareholder. There's another book that's not really referenced as much in Getting Back to Business, but really important one that all of the students, particularly the Gabelli students, should look at, which is The Modern Corporation and Private Property, Adolf Berle and Gardner Means, Berle and Means, 1932. And it's dealing with large corporations and minority shareholders for the first time. Remember, prior to the 20th century, businesses were small, and you knew someone who knew someone in the business, kind of a trust relationship. You should also look up Francis Fukuyama Trust, 1995, very interesting book. 20th century comes around, big scale businesses, scale is great, but individuals lose control and you become a minority shareholder. And Berle and Means chronicle what it means to be a minority shareholder. This is 1932. They're dealing with different problems, but the core issue is the same now as it was. I, as a minority shareholder, am giving up a lot by being a minority shareholder. I am ceding control to all of these managers. And in some cases, like Amazon, it worked out really well. In other cases, it works out terribly. The dividend becomes a mechanism for getting a balance of that control. And you can use that as a means of controlling the shareholder. Do you give up something in terms of innovation? Maybe some upside? Yeah, possibly. But in having that control, I sleep better at night than giving all of my assets and all of my money to, frankly, a group of imperial CEOs, some of whom are really, really, really good, and some of whom are incredibly reckless. And the dividend provides a balance to that exercise.
Several people have asked questions about whether your dividend investment strategy makes sense in an inflationary period, such as we may be entering today.
It's a very good question. I've been in business for 20 years on the strategy. I was just told endlessly, thousands of times, you're going to get killed when interest rates move up. During that 20-year period, interest rates only moved down. Now interest rates have moved up. We're doing really, really well. So just beware of what you're told as a truism, because as a historian, they're often not the case. As a old-fashioned kind of dividend investor, I am rooting for risk rates to go up. The more risk rates go up, the more we're going to do just fine. And you've seen that in the 10-year moving up sharply recently. As risk rates move up, it makes these less risk-oriented businesses that have cash flows to distribute, makes them look better. The problem is, or the challenge is, that a risk rate, and again, if we use the 10-year is a tricky entity, because it's the supply and demand number for the US government, which is an independent exercise. It's a risk-free rate for equities. It hasn't always been, but it is now. And it's a forecast of inflation expectations. One number trying to do three different things. Plus, it's been manipulated by the Fed for the last decade. So 4 different factors. So it's a little bit hard to read the 10-year as a risk measure, but we are happy that it's moving up. in terms of that component of the 10-year moving up, or just the emergence generally of inflation, the questioner is correct. It's a challenge for all companies, input costs, labor costs. And so we are the companies that we own in the portfolio, monitoring that as closely as possible. You want companies that have pricing power. You don't always get what you want, but to the extent possible, you want companies that have pricing power. Inflation at a high level becomes a challenge in two ways. First, operationally to companies, you're seeing that in companies, they're increasing costs before they can price those incremental costs or pass them through. And secondly, is a competition for investors. Eventually, if rates move high enough, fixed income investments, money market funds, investment grade bond portfolios will have, treasuries themselves will have an attractive yield to certain retirees. For now, those rates are still also low, even after they've moved up, that we're in fine shape. But eventually it will become competitive, and that's fine. There will become a time when, if I have a client who can get 5 or 6%, an 85-year-old client who can get 5 or 6% from a money fund, they should go and get 5 and 6% from a money fund rather than a stock fund. That's just the right thing, given their time horizon. But we're just so far away from that. So for now, inflation is something that we need to keep an eye on from a disruption perspective of the businesses. It's not yet really reflected in financial assets to create competitive threats, but it is kind of an operational issue that I have to, my day job is to make sure it's as little disruptive as possible to the dividend generation of our companies.
Here's another question, perhaps related to the sentiment of the previous question, and this is a question from Chris Nicholson. What about periods of negative real rates, even extending beyond short term, relevant to wisdom of paying a dividend? Should managers communicate like central banks about future dividend forecast?
Really good question. And modern finance was not designed for negative numbers. We've had rates coming down for 40 years. It pushed dividends basically out of the stock market, along with buybacks and the rise of NASDAQ. Those are the three main factors. It's the topic of the upcoming book. And the necessity of paying a dividend decreased over those 40-year period as cash alternative rates disappeared, as rates went down and down and down. And so, and then when they became negative, it was almost an absurd exercise because most of the rules of modern finance don't work with negative rates. That being said, grandma's still got to eat. And the fact that rates went negative over the past 20 years didn't diminish grandma's need to eat. And our goal is and has been and will continue to be to provide supper for her. Now, the alternative of just clipping a capital gain, harvesting a capital gain, has become very popular over the last 40 years. So grandma goes in and sells her appreciated shares, and she can provide for herself on the basis of those. That's worked out really well the last couple of decades. But as I started at the beginning with the statement of philosophy, business ownership, real estate, private business, even stocks, receiving a dividend from the profits of the business are profoundly different than this 9:30 to 4 going into the market and harvesting a capital gain. It's good work if you can get it, harvesting capital gain, and most investors have been able to. They are not the same thing. So as interest, we've been in business for 20 years, the particular portfolio I run, even as interest rates came down and down and down, we kept our yield roughly as flat as we could, because it's a profoundly different exercise to go into the market and create capital gains distributions as it is for dividend distributions. They're fundamentally different. Clients have been able to harvest capital gains over the past 20 years. God bless, that's great. But we stuck to the core of dividends, even though rates got so low that fixed income instruments and competitive instruments weren't paying anywhere near as much as we were. We decided to stick with the old-fashioned way.
Well, we're coming up on our time deadline pretty quick here, but at least I have one more question, and maybe Trish has another. This is from Bruno Momont, and he actually starts with a statement. He says, "Back to business is not only a good recommendation for the long-term health of the economy and society for investors, it is also good advice to management and to regulators, legislators who can shape incentives for managers. In the book, do you address this higher level public policy view of the issues that you have highlighted in this presentation?
Again, times have changed dramatically, and I'm addressing that in the book a little bit, in the next one as well. But not super thrilled with the Imperial CEO and the boards that let CEOs run amok. Now, again, the argument about Jeff Bezos is the exception that proves the rule. He's smarter than everyone, so you just let him do what you do. But in theory, we own the company. This is, again, addressed in 1932, almost a century ago, the implications of minority share ownership. Who's in charge, basically? And then Michael Jensen deals with it in the 60s and 70s in terms of who's in charge in the agency cost of scale business. I in my ideal world, CEOs work for the board, and the board is the representative of the shareholders. That's so naive. That's so old-fashioned. I know that's ridiculous. How could you possibly run it? No. But and again, when you have founder-directed firms, it's harder, obviously. But companies that have distributed ownership and don't have founders anymore running the company, in theory, this structure, this corporate governance structure we have is, it's a kind of a hierarchy, and the board is looking out for the best interests of the shareholders. This is still shareholder capitalism, not stakeholder capitalism. We can do a different session on that. And the CEO is hired by the board and the CEO hires the senior executives. Right now, that's pretty much reversed. The CEO hires the board. That's not a good formula. We see that fail over and over again. So I am critical, and not really directly my bailiwick, and I wish it were, but not. I don't have a way to change that overnight, but highly critical of the reversal of power relationships in minority shareholder businesses, where it's driven by the CEO, not by the shareholders. Again, acknowledging the innovation, acknowledging the creativity of founder-directed companies, where you do want them in charge. Where you do want them in charge. I have to acknowledge that. But for companies where that's no longer the case, imperial CEOs don't make a whole lot of sense to me. I don't have a good answer for that. You would have to change corporate governance rules, or the whole interpretation of corporate governance rules to address that issue.
Jim, Daniel, do we have time for? I see lots of very good questions, but
Yeah, keep going.
I have time.
Okay, then let me try to capture the spirit of several questions, as well as one of your most valuable insights in your talk, that dividend is a return for ownership, and ownership is very important in this whole view. So when we talk about ownership, we are also talking about long-term value, and in that context, quality of a company. And I think several questions that I see are related to this issue of quality. And how do you approach that when you take this dividend-centric view?
I'll almost approach that by acknowledging shortcomings. Companies can overpay. Companies can get ahead of their skis. Companies should reinvest more. Companies can have dividend cuts. All of that is bad. And that a quality dividend is one that is meaningful, but doesn't, you want to maximize the income stream, as in any business, but you don't want to overdo it to the point where you have to cut it. And in some cases, foreign companies outside the United States do a really nice thing. They pay a regular dividend, which is relatively low, and then they only pay a special dividend based on how much truly extra cash they have. So they avoid getting themselves in trouble. And the special dividend is variable. That's an example of a quality company, a quality income stream. In the US, that's not a common practice. I wish it were. So we do take dividend risk in our portfolios. Sometimes a company will cut its dividend, and you would say that was not a quality company. Other companies with lower yield tend to have fewer problems with that, but then they may go out and buy something. So it's a balancing act of having a quality dividend, quality company that is growing, doing well, profitable, can afford to pay a dividend, but not constraining it too much. And that's a natural balancing act. And I would say that I've seen in the marketplace, we've seen in the last 10 years in the marketplace, companies who've taken their dividend yield way, way down so that they can buy certain software companies that have 1 or 2% yields. And so their whole portfolio yields are 1 or 2%. They don't have dividend cuts. They have actually higher rates of dividend growth, but the net present value from the cash flow is low. So a quality dividend company with a 1% yield isn't, because there's no there. Grandma can't eat. The challenge is to develop, to maximize the income stream, but not overdo it. And that's something that we're obviously paid to do. Every once in a while, we will find ourselves in a distressed situation and where the company that we own probably should cut the dividend, that type of thing. So it's a balancing act in that definition of quality, but not paying a dividend is not our definition of quality. And paying a 1% dividend is also not our definition of quality, because it's just not a meaningful income stream. Why bother? So that's the balancing act that we're faced with every day.
Daniel, do you target a certain dividend payout ratio when you do your analysis?
Here there's sort of some classical themes that aren't completely off the base. Obviously, for companies that structurally are going to grow lower, we're looking for clearly majority payout ratios, well north of 50%. For companies that still do have reasonable growth prospects, and again, we tend to be in the dividend space. They tend to be older companies. If they're paying a dividend, they tend to be larger, but they still have growth prospects. So we're very comfortable with lower payout ratios. But the U.S. market and the U.S. economy, which for decades grew much faster than it is now, with a 2/3 dividend payout ratio. Let's state that again. As a historian, go back and look. U.S. economy, heavy industry economy, 20s, 30s, 40s, 50s, 60s, heavy industry, heavy reinvestment requirements, had a higher payout ratio and higher growth rates than our outsourced service asset-light economy. We should even have higher payout ratios because we're all software companies, and yet we have lower payout ratios. So that's the objection that I have, is that the payout ratio is used as a proxy for growth. Well, if you look at it as a historian, it's not. It's the opposite. Low payout ratios, lower growth. I think it's Cliff Asness had a great piece on this 20 years ago in the Financial Analyst Journal. So yeah, if companies have reasonable growth prospects, private or public companies, they should invest in them. When they're unreasonable growth prospects, we'll take the cash instead, please. And that, again, is the negotiation with management. And when you have an imperial CEO, you kind of lose that negotiation, and we try to not own those companies. They tend to have lower yields. Companies with higher yields, we are, to some extent, higher payout ratios, constraining management, and we're okay with that. We want them to invest in reasonable growth prospects, but not unreasonable ones. But the times are crazy. The payout ratio of the S&P 500 is very low. The yield of the S&P 500 is very low. Mergers and acquisitions are crazy high levels, and a lot of that money is wasted. It would be better off as a dividend.
I see that we are already a bit over time. So I want to thank Daniel Peris for this very enlightening and engaging webinar. This was our first Gabelli School Centennial Speaker Series event for spring 2022. If you enjoyed this event, please join us on February 16th at 6 p.m. when our Investment Stewardship Series will continue, featuring a discussion between Catherine Weiner, Global Stewardship Team for Goldman Sachs Asset Management, and Diane McKeever, Chief Investment Officer and co-founder of IDES Capital Management. And Daniel and everybody else, Jim and Elise, the whole team, thank you. Thank you, and thanks everybody for joining us.
Thank you for having me.